Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in your favorite companies' financial reports. Today we are diving deep into Energizer Holdings Incorporated's proxy statement for 2025, and let me tell you, it is packed with details about who is running the show and how they are being paid. Get ready for some eye-opening numbers. Alright, first up we have a letter to their shareholders dated the 12th of December 2025 from the independent chairman Patrick J. Moore and President and Chief Executive Officer Mark S. Levine. They are inviting everyone to the annual meeting of shareholders on the 30th of January 26th. Now, they are highlighting a healthy top line and record earnings in fiscal year 2025, despite a tough economy. They are also saying they returned $177 million to shareholders through share repurchases and improved their debt structure. Sounds promising so far. Now, scrolling through this massive document, we have a typical table of contents that outlines everything from the proxy summary to executive compensation and additional information. It is structured like most of these filings, giving you a roadmap of the company's disclosures. In the proxy summary, they're really pushing their strong corporate governance practices. They say they have an independent chairman, and that 9 out of their 10 director nominees are independent. They also mention a balanced approach to director tenure with an average tenure of 7.8 years. They also highlight their commitment to shareholders with meaningful stock ownership guidelines and a prohibition on hedging or pledging company stock. Looking at their board composition, they've got a mix of experience. The average tenure is 7.8 years and the average age is 63. They're emphasizing a balance of new perspectives and continuity, which is key for long-term strategy. Now let's look at the actual nominees for the board. There are 10 of them, and all except for Delaney Steele, who is a new nominee, are current directors. We see familiar names like Patrick J. Moore as independent chairman and Mark S. Levine as president and chief executive officer. Cynthia J. Brinkley is listed as chair of the Human Capital Committee, and James C. Johnson is the chair of the Nominating and Governance Committee. This is where things get interesting. Compensation highlights. Their philosophy is to pay for performance over the long term, and a majority of variable compensation is in the form of 3-year vesting equity. For fiscal year 2025, Mr. Levine's total compensation, inclusive of salary and incentives, was $11 million. They want us to know that 70% of this is variable and directly tied to company performance, and a whopping 75% of his equity incentives are performance-restricted stock units based on key metrics like adjusted earnings per S-share and relative total shareholder return. They even show that in 2025, shareholders overwhelmingly approved their executive compensation program, with 96.7% voting for it. Energizer is driven by their purpose to responsibly create products to make lives easier and more enjoyable. They are also committed to sustainability, aiming to deliver results while protecting the environment and supporting communities. They even met or exceeded 2 of their 3 core sustainability goals by ensuring 100% of new products undergo a sustainability assessment and increasing recycled content in their packaging by 53%. That is pretty solid. Here we get into the nuts and bolts of how the board operates. They have a 4-committee structure: audit, human capital finance, and oversight, and nominating and governance. Each committee has specific responsibilities to ensure all aspects of the business are overseen effectively, from financial reporting to human capital management. Energizer does not have a rigid policy on whether the CEO should also be the chairman. Currently, they have an independent chairman, which they feel is the best structure for them. Mr. Moore, as independent chairman, has a pretty long list of duties, including calling meetings of the board, leading executive sessions, acting as a liaison between directors and the CEO, and overseeing CEO succession planning. Let's break down the committees. The Audit Committee, consisting of Rebecca D. Frankiewicz, James C. Johnson, Donald L. Mulligan, and Robert V. Vitale, as chair, is responsible for reviewing internal audits, financial reporting, and risk management. They also oversee the company's cybersecurity and the environmental aspects of their ESG program. The Finance and Oversight Committee, chaired by Kevin J. Hunt, with members Mark S. Levine, Donald L. Mulligan, and Robert V. Vitale, reviews financial conditions, strategies, and major transactions. The Human Capital Committee, chaired by Cynthia J. Brinkley, with members Rebecca D. Frankiewicz, Kevin J. Hunt, and Necker L. Rimmer, oversees culture compensation and human capital management, including executive compensation and succession planning. Finally, the Nominating and Governance Committee, chaired by James C. Johnson, with members Cynthia J. Brinkley, and Necker L. Rimmer, handles director nominations, board composition, and corporate governance policies. The board makes sure there are plans in place for future leaders. They regularly discuss management succession in executive sessions, and with the CEO reviewing candidates and development plans. The independent chairman leads the CEO succession planning, and the CEO reviews development plans for other senior roles with the board. Every year, the board and its committees conduct self-evaluations. This process involves written questionnaires that cover everything from leadership effectiveness to board materials and relationships with management. It is all about continuous improvement. The Nominating and Governance Committee keeps an eye on the board's composition, looking for the right mix of skills and experience to support Energizer's long-term strategy. They even use independent search firms to help identify potential candidates. They also have a rule that directors are not eligible for election after age 75 unless there are unusual circumstances. Energizer actively engages with its shareholders throughout the year. They highlight their successful say on pay votes where shareholders overwhelmingly approved executive compensation. This feedback influences their compensation decisions. They also engage with institutional investors on governance topics. The board is heavily involved in the company's strategic planning process. They hold annual strategy planning meetings with senior leadership and review progress against the plan throughout the year. Risk oversight is a big deal for the board. They and their committees are actively involved in overseeing significant risks impacting the business. Each committee focuses on specific risk areas. The audit committee looks at financial reporting, cybersecurity, and environmental ESG aspects. The Human Capital Committee focuses on culture compensation risks and social ESG aspects. The Finance and Oversight Committee deals with financial condition, insurance, and capital allocation. And the Nominating and Governance Committee oversees board effectiveness, governance strategy, and ESG governance aspects. Energizer emphasizes its code of conduct, which applies to everyone, including the board and senior management. They have a robust ethics and compliance program with multiple avenues for reporting concerns and no tolerance for retaliation. Shareholders can communicate directly with the board by writing to the corporate secretary. The secretary reviews all correspondence and forwards to the board anything that requires their attention. Financial and accounting concerns go directly to the audit committee chair. Energizer is a global branded consumer products company, and the Nominating and Governance Committee is responsible for recommending director candidates. They consider a wide range of criteria, including integrity, professional background, and industry experience. They do have an overboarding policy, meaning directors can only serve on a certain number of public company boards. For directors, they look for integrity, energy, forthrightness, analytical skills, and commitment. They evaluate candidates based on their background, accomplishments, and experience. Key criteria include being engaged, having high integrity, and being free of conflicts of interest. They also emphasize that directors should be able to devote sufficient time to company affairs. The board has a diverse set of skills and experiences represented. We see executive leadership experience, operations, sales, and marketing, CPG industry experience, global international experience. Financial expertise, legal compliance, human capital management, M&A, and corporate strategy, public company governance, and ESG. The number next to each skill indicates how many directors possess that particular expertise. For example, 10 directors have executive leadership experience. This ensures the board has the right tools to guide the company. This section details the nominees for the board. It outlines their names, ages, principal occupations, and any other public company directorships over the past 5 years. This is where you find the nitty-gritty on each individual director. Cynthia J. Brinkley, a retired Chief Administrative and Markets Officer from Centene Corporation, brings executive leadership and human capital management experience. She also serves on the board of Amarin Corporation. Rebecca D. Frankie-Wicks, President and Chief Strategy Officer at Manpower Group, has executive leadership and operations, sales, and marketing experience. She also has CPG industry experience. She currently serves on no other public company boards. Kevin J. Hunt, a retired CEO and president of Railcorp Holdings Incorporated, has extensive executive leadership and financial expertise. He previously served on the board of Clearwater Paper Company. James C. Johnson, a retired general counsel from Loop Capital Markets, LLC, brings legal compliance and public company governance experience. He has served on the boards of Hanes Brands Incorporated and Edgewell Personal Care Company. Mark S. Levine, President and Chief Executive Officer of Energizer Holdings Incorporated, has executive leadership and deep knowledge of the CPG industry. He also serves on the board of Lazy Boy Incorporated. Patrick J. Moore, Independent Chairman of Energizer Holdings Incorporated, is also CEO of PJM Advisors, LLC, and has extensive executive leadership and financial expertise. He serves on the board of Archer Daniels Midland Company. Donald L. Mulligan, a retired EVP and CFO of General Mills Incorporated, brings significant financial expertise and CPG industry experience. He also serves on the boards of Tennant Company and Herbalife Limited. Neka L. Rimmer, a retired president of Global Flavors and Extracts at McCormick & Company Incorporated, has CPG industry and M&A strategy experience. She serves on the board of Constellation Energy. Delaney Steele, an executive vice president at Ross Stores, is a new nominee bringing executive leadership and operations, sales, and marketing experience. She also has CPG industry and public company governance experience. Robert V. Vitale, President and Chief Executive Officer of Post Holdings Incorporated, provides strong leadership and deep M&A and capital markets expertise. He serves on the boards of Post Holdings Incorporated and Bellring Brands Incorporated. All directors attended at least 75% of board and committee meetings in fiscal year 2025. They also encouraged directors to attend the annual meeting, and all of them did attend the 2025 meeting. Non-employed directors are required to own stock valued at 5 times their annual cash retainer. For fiscal year 2025, director compensation was set around the 50th percentile of their peer group. The annual retainer for directors was $100,000 with additional retainers for committee chairs and the independent chairman. They also receive restricted stock unit awards valued at $150,000 annually. The audit committee has appointed PricewaterhouseCoopers LLP or PwC as their independent auditor for fiscal year 2026. PwC has been their auditor since 2000. The fees paid to PwC for fiscal year 2025 were $5.18 million and for fiscal year 2024 were $4.845 million. These fees cover audit-related tax and other services. The board recommends a vote for the ratification of PwC as their independent auditor. They consider this appointment to be in the best interest of the company and its shareholders. The audit committee reports that they have reviewed and discussed the financial statements with management and PwC. They have also evaluated PwC's performance and independence, and have recommended to the board that the audited financial statements for the year ending the 30th of September 2025 be included in the annual report, and that PwC be selected as the independent registered public accounting firm for fiscal year 2026. Shareholders are asked to vote on an advisory basis to approve executive compensation. The board notes that shareholders overwhelmingly approved this proposal in 2025 with 96.7% in favor. They believe the compensation is aligned with the company's performance and helps attract and retain talent. This section is all about how much the top executives are paid. It includes the compensation discussion and analysis and executive compensation tables. The company's compensation philosophy is to pay for performance over the long term. A significant portion of executive pay is variable and tied to company performance. 7 named executive officers or NEOs are listed, including Mark S. Levine as President and CEO. A key point here is that for fiscal year 2025, 70% of the CEO's compensation and 60% of other NEOs' compensation was performance-based. They are reiterating that the strong shareholder support for executive compensation in 2025 has influenced their decision to maintain their current approach. Energizer's compensation program is designed to align executive and shareholder interests. They emphasize simplicity, alignment, and balance. They do not pay tax gross-ups on compensation and prohibit speculative trading, hedging, or pledging transactions. Severance payments are generally capped at 2 times salary and annual incentive awards, except in change of control situations. This graphic highlights that for the CEO, 70% of compensation is performance-based, and for other NEOs, it stands at 60%. This reinforces their pay for performance approach. The pay components remain the same as fiscal year 2024. These include base salary annual incentive programs and long-term incentive programs, which are performance and time-based restricted stock units. Retirement and other benefits are also provided. Executives are required to own company stock valued at multiples of their base salary, aligning their financial interests with shareholders. The CEO needs to own 6 times base salary and other executives 3 times base salary. Directors, officers, and employees are prohibited from hedging or monetization transactions with respect to Energizer securities. This includes trading in options, short selling, and purchasing financial instruments designed to profit from changes in the market value of company stock. Pledging company stock is also prohibited. In case of an accounting restatement, the Human Capital Committee can recover certain incentive-based compensation paid to executive officers if it was based on erroneous financial results. The compensation evaluation process involves a thorough review of financial results. They use a balanced and disciplined approach considering various factors. They also rely on an independent compensation consultant variant for advice on competitive landscapes and compensation trends. Their peer group includes US-based publicly traded companies in household and personal products industries with similar revenue and global reach. For fiscal year 2025 and 2026, the peer group composition was reviewed and found to be appropriate. The Human Capital Committee targets total compensation near the 50th percentile of the market. They review size adjusted market compensation for Energizer's revenue size. The Human Capital Committee conducts an annual performance assessment of the CEO considering individual and company performance and market practices. For other NEOs, the CEO makes recommendations to the committee. The annual compensation timeline spans fall, winter, and spring-summer, covering performance assessments, incentive program updates, and peer group analysis. The primary elements of their executive compensation program are base salary annual incentive program, long-term incentive program, which includes performance, and time-based restricted stock units and retirement and other benefits. Base salaries are determined based on job scope, experience, market comparable positions, and operating results. The goal is to be competitive while aligning with their compensation philosophy. For fiscal year 2025, base salaries were increased considering the company's operating results in fiscal year 2024. The annual incentive program is based on performance against three equally weighted metrics: adjusted net sales, adjusted EBITDA, and adjusted gross margin rate. For fiscal year 2025, the company achieved 87.67% of its total bonus target. Actual bonuses are interpolated for performance between threshold and maximum goals. This program consists of performance-based and time-based restricted stock units. The performance-based units are tied to cumulative adjusted earnings, per S-share, and relative total shareholder return over 3 years. The time-based units promote long-term retention. The long-term incentive awards granted in fiscal year 2022 paid out at 174% of target. This was based on cumulative adjusted earnings per S-share and relative total shareholder return over a 3-year period. This is an excess 401k plan for certain executives. It covers contributions that exceed IRS limits. There are defined benefit pension plans in place, including a supplemental executive retirement plan. These plans were frozen as of the 31st of December 2013, so future benefits are no longer accrued. For fiscal year 2025, limited perquisites were offered, including a US executive financial planning program, cybersecurity subscriptions, and an executive physical wellness program. Mr. Vorth also receives a company car allowance. The company has an executive severance plan and change of control employment agreements with its NEOs. These provide severance and benefit continuation in the event of a qualifying termination following a change of control. The arrangements were updated in fiscal year 2025. The Human Capital Committee reviewed the compensation discussion and analysis and recommended its inclusion in the proxy statement. These tables provide a detailed breakdown of executive compensation. For fiscal year 2025, CEO Mark S. Levine's total compensation was $10.97 million. This includes base salary stock awards, non-equity incentive plan compensation, and other compensation. John J. Drabick, the CFO, earned $2.79 million. Michael A. Lampman earned $1.98 million, Robin W. Vorth earned $1.87 million, and Laurie Shambro earned $1.84 million. Notice that stock awards are a significant portion of the CEO's compensation. This table shows potential payouts under annual and long-term incentive programs. For Mr. Levine, the potential annual cash award payout ranged from $653,438 to $2,613,750. His long-term incentive awards are substantial as well. As of the 30th of September 2025, the NEOs had significant outstanding equity awards. Mr. Levine's outstanding equity awards had a market value of over $14 million if all awards were to vest. This table shows the value of stock awards that vested for the NEOs in fiscal year 2025. Mr. Levine realized over $4.8 million from vested stock awards. This table shows the present value of accumulated benefits under various pension plans. It is important to note that these plans were frozen years ago. This table provides details on deferred compensation plans, including contributions, earnings, and year-end balances. Mr. Levine's executive savings investment plan balance was over $5.9 million at the end of fiscal year 2025. This section outlines potential payments to NEOs in the event of termination or a change of control. In a change of control scenario, Mr. Levine could receive severance and accelerated equity valued at over $29 million. The company reports that their CEO's compensation was approximately 259 times the median annual total compensation of all other employees. The CEO's compensation for fiscal year 2025 was over $10.9 million, while the median employee compensation was about $42,325. This table shows the relationship between executive compensation actually paid and the company's financial performance. For fiscal year 2025, the CEO's compensation actually paid was over $8.6 million, and the average compensation for other NEOs was over $1.8 million. They highlight net income and adjusted earnings per share as key performance indicators. This chart illustrates the connection between executive compensation and the company's total shareholder return and its peer group's TSR. This chart shows the link between executive compensation and the company's net income. This chart visualizes the connection between executive compensation and the company's adjusted earnings per share. The key performance measures used to determine compensation include adjusted net sales, adjusted EBITDA, adjusted gross margin rate, adjusted earnings per share, and relative total shareholder return. This section covers stock ownership information, equity compensation plans, and certain relationships and related transactions. BlackRock Incorporated and the Vanguard Group are the largest shareholders, both holding over 13% of the company's common stock. Aqua Capital Limited and FMR LSE also hold significant stakes. The table shows that directors and executive officers hold a combined total of over 1.1 million shares, representing a small percentage of the outstanding stock. Mark S. Levine holds the largest individual stake among the named executive officers. As of the 30th of September 2025, there were over 2 million securities available for issuance under equity compensation plans. All reporting persons are believed to have filed their required Section 16 reports on time for fiscal year 2025. The company has a policy for reviewing and approving transactions with related parties. During fiscal year 2025, no such transactions required disclosure under CC rules. Shareholders can vote by mail, telephone, or internet. The meeting will be held virtually online. The annual meeting will be held online at www.virtualshareholdermeeting.com/ENAR2026. Shareholders can vote electronically and submit questions during the meeting. You can vote your shares by mail, telephone, or internet. You can also vote during the virtual annual shareholders meeting. A majority of voting power is required for approval of most proposals. Abstentions and uninstructed shares held by brokers generally have no effect on the outcome for director elections and advisory votes on executive compensation. The board of directors is soliciting proxies and will bear the costs. To reduce costs and environmental impact, proxy materials will be delivered in one envelope to households with multiple shareholders sharing the same address unless they opt out. The board does not intend to bring any other business before the meeting. Shareholder proposals for the 2027 meeting must be received by the 14th of August 2026 to be included in the proxy statement. This section outlines the company's expectations for future results and mentions numerous risks and uncertainties that could impact actual outcomes. These include economic conditions, competition changes in consumer preferences, and potential product liability claims. This appendix provides reconciliations of non-GAAP financial measures used by the company, such as adjusted earnings per share and adjusted EBITDA, to their closest GAAP equivalents. This helps to understand the adjustments made for things like restructuring costs, acquisition expenses, and production credits. So what is my take on all of this? Energizer is definitely focused on performance and shareholder alignment. Their compensation structure heavily weights variable pay and long-term incentives directly tied to financial results. The company's commitment to sustainability and responsible practices is also a strong point. However, their reliance on non-GAAP measures in financial reporting, while common, can sometimes obscure the true underlying performance. The large difference between CEO pay and median employee pay is quite stark, though that is not unusual in corporate America. Overall, Energizer appears to be strategically navigating challenges and aiming for growth, but prudent shareholders should always keep an eye on those non-GAAP adjustments and the long-term impact of their decisions. Alright, that is our deep dive into Energizer Holdings Incorporated's 2025 proxy statement. What are your thoughts on their executive compensation and governance practices? Let us know in the comments below. If you found this analysis valuable, please hit that like button and subscribe for more corporate insights. And as usual, check out our Discord community linked in the description if you want to keep the conversation going. Thanks for watching, and we will see you next time on Corporate Decoder.